Welcome to Two Quants and a Financial Planner, where we bridge the worlds of investing and financial planning to help investors achieve their long-term goals. Join Matt Ziegler, Jack Forehand, and me, Justin Carbonell, as we cover a wide range of investing and planning topics that impact all of us and discuss how we can apply them in the real world to achieve the best outcomes in our financial lives.
Justin Carbonell and Jack Forehand are principals at Validity Capital Management. Matt Ziegler is managing director at Sunpoint Investments. The opinions expressed in this podcast do not necessarily reflect the opinions of Validity Capital or Sunpoint Investments. No information on this podcast should be construed as investment advice. Securities discussed in the podcast may be holdings of clients of Validity Capital or Sunpoint Investments.
All right, guys. What we thought we'd do today is sort of another fact or fiction type of episode. We did one a few episodes back, and I think it was received pretty well by our listeners and the audience. But, what we thought we would do is just kind of take some of the issues that might be on investors' minds today or other things that we think are interesting and discuss sort of the merits of them, whether or not these things can be predicted, how investors should be thinking about these things, and, how they may influence one's view on the markets and someone's investment strategy. And so it's a pretty diverse list that we're going to go through. And there's not any rhyme or reason to the order, but we'll sort of just start with one of the things that I think is on a lot of investors' minds and has been for the last few years is this idea of whether or not inflation can be predicted or not. And, if you think about kind of how we came into this year, maybe this is a good setup for kicking it over to you guys, was a lot of people were predicting the Fed was inflation was done. The Fed was going to be lowering rates at least a few times throughout 2024. And here we are with, inflation remaining pretty higher than the Fed wants it. And, the Fed not looking like they're going to be easing as aggressively as a lot of people thought. So maybe I'm answering my own question here about whether inflation can be predicted or not, but I don't know. What do you guys think?
Yeah, well, I think this is fiction, the idea that inflation can be predicted, although I have a little bit of a nuanced answer. But first, I want to tell you guys that inflation is over. Basically, you can stick a fork in it. It's done. Because yesterday, I went to a financial planning conference yesterday, and I had to go get my CE. So I had to endure some presentations, which it's fair to say that the people making the presentations had paid to be there to make the presentations. And the first half of every one of those presentations was higher for longer. High inflation's with us to stay. It's not going anywhere. So whenever you see, if there's no better contrarian indicator than when everybody at these financial conferences is presenting this idea of inflation and higher for longer, it is over. But before I let you guys comment on that, can you guess what the second half of their presentation was about?
So rates are higher for longer, or inflation is higher for longer.
Yes, yeah.
That's
basically,
the
theme was tied into REITs are going to be higher for longer because inflation's here to stay. So those types of organizations, if they're going to make a presentation where they make that case in the first half, what might they be doing in the second half, you think?
Well, assuming it wasn't Costco and gold bars, no. I'm going to have to go with private equity, private credit, and nobody's so daring at one of these conferences to be short corporate real estate, but do tell. What were they selling?
You did get that right. My general answer was they were going to talk about a product they offer that happens to be perfectly suited for a high inflation environment. And so that's what we got in the second half. We got a bunch of products that are perfectly suited for a high inflation environment, including, private equity, by the way, which I'm told reduces the volatility of my portfolio substantially. I learned in the conference. So that's also good to know for me in the future, because I didn't know if that actually was the case, but it turns out if I just add that private equity, the volatility goes way, way down. So anyway, I've gone off on too much of a tangent here, but in general, the idea that inflation can be predicted, I think there are elite people, and we might talk to some of them on Tuesday for our P&L for a Purpose thing. There are some individuals who absolutely, I think, can do a decent job of predicting inflation. I think they're in the small minority. So for your average person to be out there trying to figure out, can I predict inflation? Can I pick the right person who knows how to predict inflation? I think that's very, very hard to do. I think your average person should assume that this is fiction and inflation cannot be predicted.
I want to add to it that inflation itself, let's pause it for a second. Even if it could be predicted, why does it matter? Like, you have to have something tied to it. So tied to the people who might be able to say, I think inflation is going to be higher for longer. I think inflation is going to be coming down. What are you going to do about it? if I want to give speeches at conferences and I want to say inflation is higher for longer, and I really think there's upward wage pressure, and oh, by the way, I'm going to sign this contract for next year, and I'd really like to pay less if I have to pay to play and present at this conference, but I'd also really like you to pay me more if I have to present at this conference. Like, what's the variable next to inflation that you're actually going to put your trade on, that you're going to put your money where your mouth is, that you're going to profit from this knowledge? Because it doesn't matter. We can sit here and rattle off where we think core PCE or headline CPI is going to be in a week or 3 months or a year. It doesn't matter unless we're positioning something else around it. And even that, it only matters how it changes versus the perception of where we are now. So no, I don't think it can be predicted. And B, I think these other things, you can have stated views where inflation as a variable influences how you put the position on or make the stated view and what you're doing.
Yeah, I agree with you guys. But I do think with, the benefit of hindsight, when you think back to the drivers of inflation over the past few years, it's now pretty obvious what those were. I mean, you had, massive fiscal stimulus combined with, the supply chain issues and disruption. And I remember like the one person that I think got it largely right more on the fiscal stimulus side was Jeremy Siegel, looking at M2 money supply and pounding the table on those wisdom tree advisor calls where he was, months in advance of when inflation started raging. He was like, inflation's coming. Now he's like an exception, not very many other people were on his bandwagon as early as he was, but all I'm saying is, and it's never the same, right? Like the next time inflation really, is high, it's probably going to be a result of a different set of factors and circumstances. But I think at least for me and looking back, we can learn from what those drivers were.
No, I think that's fair. And also I think the more you if you're going to try to predict it, the more you look at it as a long regime type thing versus, inside of every year, I'm trying to figure out, is it high? Is it low? Is it going back up? Is it going down? I mean, because we've talked to some pretty thoughtful people who think, we're in for like 5+ years of above average inflation, and they're going to put like a 5+ year investment strategy together with that. That to me makes more sense than, higher for longer, and now it's recession, and now it's whatever. I mean, like I think the GDP number was like really, really low today. So like if you're bouncing around with that, if you're like, oh, inflation was above and now GDP is low, and that's where you're going to get yourself in a lot of trouble, I think.
That's where you get yourself in trouble. And that's where also you're going to you'll get in trouble because you'll misread the opportunity. But if you look at inflation as an input in the broader context of things. So, and credit to the Jeremy Siegels and some of the other people who had been calling for this and got kind of the turning of it right. Because there were lots of people calling for inflation when it was all fiscal, when it was all monetary and no fiscal before, right?
Right.
The inflation is going to come roaring back arguments like post-financial crisis. Credit to the people who held off until we had fiscal and COVID. But inside of that, if you're a long-only stock person, I'm not speaking for Jeremy Siegel, but I'm just saying from that perspective, then you would go, okay, this variable and my otherwise thoughtful calculus of all these different variables, here's how it responds when I increase the inflation number. And that could have been done to say, maybe this is where I'm avoiding duration in bonds. In one sense, that could be done in a way where you're going, great, this is going to increase revenue, but increase costs for companies at disparaging ways across this long-only equity portfolio. Those are useful ways to use what you think inflation is doing. And Jack, to your point, I love this, over the regime. And Justin, I agree with you. If you can piece that stuff together and you have a sensible thing you can follow, as long as you don't let yourself get too wrong for too long, that's useful.
Even though inflation might not be predictable, just to be like these guys at this conference, I do have a QR code available. So if you scan this QR code, you'll go to a website that has products I can offer to help protect you from an inflationary environment.
Inflated.
There were a lot
QR
of QR
codes
codes yesterday. There were a lot of QR
I bet
codes.
there were.
Did you guys happen to read Kai Wu's latest piece on international intangible value? Do you know what I'm referring to here? Okay. So
I have not. Please educate me.
It's really, I mean, Kai's stuff is always so good, but he basically starts out with, and this kind of plays into this next point. He sort of starts out with how much better US stocks have done versus international stocks over the past, I don't know, 10 or 15 years, whatever it is. And then he basically kind of goes through and talks about how much our market cap driven weighted indices are, a lot of the value there is like intangible value. So companies that are investing in intangible assets, and the way that he gets at that. And then he sort of is like making the case that, even in international markets, if you look at those stocks that have a high degree of intangibles, those international stocks actually outperform like the broader international, markets in general. So he's making the case for, investing in companies that have a high amount of intangible value, basically. And he gets at that through looking at patents and intellectual and all that kind of stuff that he looks at when trying to derive intangible value. But the point where I was kind of going here is, this idea that investors should use different strategies in different regimes. And, I've long thought, and it's kind of like Ned Faber's been in this camp too, that, international stocks, given their relative valuation, given their cheapness, look attractive from, your traditional value investor standpoint. And, there are times in history where you have these regimes. I mean, think back to 2000 to 2000, maybe, I don't know, 5, it was the BRICS or whatever, those markets that were doing great. And so I don't know, this idea of investing, following various strategies based on market regimes. And I was trying to back into it, kind of highlighting sort of some of the point, I guess, that I was making.
Yeah, first, before we get into this, like if I was like a young basketball player, there's probably nothing I would want more than like Michael Jordan tweeting and being like, this kid's got game. If I was writing a paper like Kai writes, there's probably nothing I would want more than Michael Mauboussin tweeting and saying, I've been sharing this liberally, which is what he did with his paper with Kai. So it must be really cool, like to think about that. Like it's obviously an incredible paper where Michael Mauboussin is sharing it liberally with everybody. But on this idea of regime dependent strategies, I mean, I think in general, this is fiction. I mean, I don't think you should be, I think you really most people need to have a strategy that works over the long term and be able to stick with it over the long term. I think when you start, even for long regimes, when you start trying to change it, you run into this trap of when do I change it back? How much do I change it? So I don't think in general that's a good idea. But the other thing you could argue is the 60-40 portfolio a regime dependent strategy? Well, to some degree it is. It's a regime dependent strategy on inflation not being high. So if I'm going to have a regime independent strategy, you could argue that maybe stocks and bonds is not enough for that. If I want that strategy that works in all regimes, I probably need something else in there. So I think people who invest in 60-40 portfolio are going to be perfectly fine over time. Although we just went through a bad period, if you stick with it for really, really long periods of time, there's no reason not to believe stocks and bonds won't produce a risk premium and you won't get a good return. But I think if you're going to have, whether you're going to have the 60-40 or whether you're going to have something else, I think the key is you've got to have it all the time. I think even if it's over long periods, when you get in this trap of trying to change it back and forth, I think it becomes too problematic.
I think like the inflation point, you can have regime-based views that you put inside your stuff. You can take like the paper that you cited. You can have things where you go, I believe inflation will be higher for longer, and I'm going to express it in this part of my portfolio, not necessarily with the whole portfolio, with this part. Those types of tilts can serve two purposes. One, it can serve the purpose of you being right. Two, that's nice when that happens. Two, it can serve the purpose of helping you stick to the course on the broader investment strategy. And we see this all the time with financial planning, where it's like, you could express just having exposure to tech stocks or maybe having an overweight to tech stocks in the last 10 years. You could express this in thinking there's inflation and making sure you have energy or other things that are pro-inflation benefiting asset classes in your portfolio with a little bit more than they are in the indices, or a little bit more in your 60-40 mix or whatever else. So fiction that if you think you can just time regimes all over the place, that's dangerous. Better approach would be just have one thing that works in multiple regimes all the time. And sometimes the behaviorally best approach is, if you must fiddle, is it Cliff Asness? Who's Sin a Little? I think it's Cliff Asness.
It is, yes.
Yeah. like that's a really great thing to keep in your mind for most people, because we like talking about this stuff. It's like people who like to talk about sports or like to talk about music or like to talk about whatever. It's okay to sin a little, have a little sidecar money or a way to put these tilts on that's not going to blow up the whole strategy and turn you into the guy who's like, I'm all gold all the time, or all Bitcoin all the time, or only stocks for the long haul and nothing else. And yeah,
I don't know.
Stay away from that mode of thinking.
I don't know if you intended to make a rhyme there, Matt, but you actually did. Like, if you must fiddle, sin a little. You might be so good at this that you're doing it without even thinking about it.
I'm Neo in the Matrix.
Matt, you may know more about this, but I do know that like these big wirehouses and brokerage firms, oftentimes there's like a CIO like office, and there's views that they give to their financial advisors. Like I'm thinking, 2024 was supposed to be a year of quality, stocks. And I'm just wondering, as someone that sat in that seat at Merrill Lynch for all those years, and, maybe research was coming from Richard Bernstein, whoever these strategists were, how did you sort of balance that? Because I could see the appeal to some extent of sitting down and talking to a client, like, these are the views of the firm, and here's how I'm implementing those for you. Because it gives you something to talk about. It gives you something to sit down with the client. But maybe to your point, it's just these little sort of tweaks on the edges that kind of make it so it looks like, maybe you're doing more than, I don't know. So how did you deal with that?
So first and foremost, any CIO of any large firm or any small firm for that matter, like what you're really doing is its marketing strategy. Now, behind that, there has to be some actual strategy. You want people who can actually do the math and like do the things to put a portfolio together and take stuff into consideration, like correlations and stuff like that. Even if you can't prove it all, it helps if you have a couple of CFAs hiding behind the scenes who can crunch these numbers. The real way you should look at it when we talk about, and whether we're picking on whatever the CIO out of BlackRock is saying this week, or the CIO out of Vanguard, or the CIO out of Wells Fargo, or Morgan Stanley, or Merrill Lynch, or whoever, they're basically telling you what vanilla ice cream tastes like at the end of the day. And it's one of those things. It's not terribly interesting. They're trying to get something that doesn't get anybody into trouble. There's a huge compliance layer to all this stuff, and give them a story to sell it with, so that it's not just grocery store generic brand vanilla ice cream. It's, this is the super fancy, only from some sweet cream distillery in like Northern Oregon. Here is the most specialist of vanilla ice cream ever. And you're like, that's fascinating. But it's just friggin' vanilla ice cream at the end of the day. The greater purpose that all CIOs at the big shops do is they do basically what Starbucks did to gas station coffee. And the idea is when Starbucks shows up, this is a Rory Sutherlandism, when Starbucks shows up on the scene, all of a sudden there's drive-thrus everywhere, and there's places to walk in and get an, albeit perhaps overpriced, but a pretty good cup of coffee. Same thing happens as like Dunkin' Donuts expands into everywhere, and before they were America runs on Dunkin', when they were still Dunkin' Donuts. What this does is it raises the threshold of crappiness. And this is a really important concept. So instead of having Tom the broker, and it's always a guy, Tom the broker who's out there putting together these, portfolios of A shares and random stocks, where he has no rhyme or reason or idea of how to do portfolio construction, but he's throwing together. Sometimes he's going to be right, but other times he's going to build a really crappy portfolio. I can't tell you how many. I know it's a broker of a certain age from a place, if it's a 60-40 portfolio, where the entire bond portion of the 40 is basically like overpriced high yield mutual funds. It's like, is high yield really bonds fixed income in this thing? I'm pretty sure the correlation, you can always tell those people. So what the CIOs at the big firms do is just like when Starbucks shows up and now the Valero down the street, that pot of coffee that used to be a joke as sludge in like the 80s and the 90s, all of a sudden they're like, Starbucks is right there. Nobody's buying coffee anymore. We can't move an extra candy bar when somebody fills up their tank. Starbucks raises the threshold of crappiness. When the CIO says, we like quality this year. Who gets fired for liking quality this year? I'm still going to give you the same old pot of like mediocre coffee, But the bottom line is way lower odds you're going to get a really trash, horrible, crap cup of coffee, because stuff like this just helps bring up everybody's awareness. That's a net positive, by the way.
I was thinking when you were saying that, I was thinking I used to work in this high-end wine store in high school, and like they would always sell these $50 bottles of wine, and like the wine guy, when people would come in and they'd ask for his description of it or whatever, he'd be like, "Oh, that is subtle yet complex," and like what is he even talking about? So I would ask him, like, after people left, I'm like, "What the hell are you talking about? Like, do you even know what that is?" He's like, "I have no idea what that means. I just got to sell it to push the $50 wine." So yeah, I think this whole high-end thing is yeah, I mean, it's been going on for a long time, but it's Starbucks and stuff has definitely brought it to a new level.
A few like a month ago, my wife and I took a weekend to get out of town, and we went to a really nice restaurant in Westerly, Rhode Island, and we did like the fine dining thing, and
because we food in Westerly, there's some good spots.
Yeah. So right next to Taylor Swift's house, actually, interestingly enough. So the butter, when they brought the rolls in the butter, we were told that the butter came from a farm with only 8 cows.
I had 9 cow butter at my farm the other day, and I was just like, nice too much. Too much.
It's like the old 8-minute abs versus like the 7-minute abs or whatever thing.
Yeah, the something about Mary version, right?
Yeah. Hey, let me ask you guys this. If you got to exclude Buffett here, okay? But if I were to ask you to name one really great investment manager that's currently running a fund, who would come to mind for you?
I mean, do I have to stay away from the quant guys? I can't name Ken Griffin, can I? Who's just like scalping a little bit off the top of everything.
Yeah, I mean, those big hedge fund guys, but I mean, yeah, I mean,
like an actual guy who's been personally picking stocks.
Yeah.
Yeah, no, it's very hard.
I don't have anybody off the top of my head. I could think of like Cuppy and some people like that who have put up like wild returns in the last 2 years, but it's a short list of people like this.
Especially like household name type guys, like somebody who would be a household name, like, because most people won't know. I mean, you're right. He's put out crazy returns, but most people won't know him. Like, is there like a household name person who has consistently put like up outperforming returns? I mean, it's hard to come up with one. At least in this new era. I mean, you know, you have Buffett from like a very long era, but like in terms of like newer guys, like, yeah, I don't know. I can't come up with one really.
Yeah. So it's you know, that was the next thing here is like the gray era. Will there ever be another Peter Lynch? You know, once Buffett is gone, will there be another Buffett? Probably not Buffett. And that's exceptional. His long-term track record, 20% over 65 years. But yeah, it's a good question.
Yeah, no, I mean, I think this idea that the era of the great investment managers over is a fact. You know, I think maybe you'll see a one-off guy here and there, but I mean, we also have to take into account, I mean, computers are taking over, AI is coming, like an actual individual who's sitting there picking stocks, outperforming the market for 30 years. I mean, that type of person, I mean, it's going to be very, very hard to do that. And yeah, I just don't know that. I mean, I don't think that's going to happen again.
I think it's interesting. And this is going to be a half-formed thought because I was just thinking about this today, but I think it's relevant here. So we just had, you mentioned being next to Taylor Swift's house where you're getting your 8 cow butter. She just released a new album, and it's like fastest album to, I think it was 1 billion streams on Spotify, something completely insane, like in the numbers. And there was an argument. It was I think it was Priceonomics, however you say it, a few years ago. And it was basically like why there's no more one-hit wonders anymore. And the idea was basically like, whether it's information or how we share this stuff or how we stream and consume this stuff, that there's just like the room to have like a Chumbawamba or a Dexy's Midnight Runners or a whatever is just like, they've been crowded out. It's all Taylor Swift all the time. It's really hard to have like a runaway thing. And then if you do have a runaway thing, you end up with, red bottom shoes and like Cardi B. You end up with like people like that who like they punch up into that thing, but then they're able to like hold in that status for a hot second, or at least for a couple albums. And I feel like with like the best managers, it's kind of just like, I don't know if Vanguard's the Taylor Swift at this point or if Buffett's the Taylor Swift. I'm going to go with Buffett and Taylor Swift have more in common on this. But I think we've like crowded out that ability. None of us talk about the active managers anymore. So I can turn around and say like Cuppy and Praetorian put up like insane numbers through the pandemic and the period following doing event-driven stuff. But like, that's like me talking about some obscure punk band. Like I might as well be talking about like Idols or something like that right now. And I think that's really interesting. Our cultural awareness and care of a manager, even if they have great numbers, we're not going to talk about it unless it's Buffett or Vanguard. It's got to be Taylor Swift or Drake or Beyonce right now to even appear on society's radar.
I love that. I think that's a great, I mean, the crowding out, it's like, it's gotten so much, you know, the flow to passives, the long-term record of active managers, you know, not outperforming the broader market. And so, you know, even if you get someone that has shown the ability over time, it's you know, the first question a lot of investors ask is like, well, what, you know, what does it cost? If it's not the cheapest thing out there, you know, I don't want it. You know, that's part of the
huge
part
aspect
of the equation.
too.
Yep.
And because
And also-
everybody's aware of it, because we say, how much does it cost? And then we make the comparison to like Vanguard. And there's nothing worse than taking like a highly active private strategy that might, you can go out and do like venture capital and pay your 2 and 20 and be a GP or an LP or whatever you're going to be. But like, you can't compare that. Like that's not an apples and apples comparison to like a Vanguard, you know, large cap fund or something.
Yeah, and all this is a good point because there really are two parts to this whole famous, you know, legendary manager thing. One is the actual performance, and two is the famous.
Right.
And there are people fulfilling the first one right now,
That's
which
true.
I probably missed a little bit of my answer. There are guys behind the scenes that are putting up ridiculously good numbers, but the fame part is not coming with it. I mean, to some degree, maybe they don't want it,
Good
but
point.
also
Good
like
point.
the way the world is, like they're not getting it. So I think that's why this is fiction. Is like the ability to put both of those together is probably going to be very, very hard.
Very, yeah. And then look at like, I'm sure you guys have seen all the charts going around for like Kathy Wood again lately, or it's just like,
Yeah, she's
you
missing
don't have
part,
the numbers.
She's missing part one of the equation.
She's got the fame part, but she
Right.
doesn't have the returns part. And it's savage when you look at the numbers. I found it, so it's Priceonomics, The Death of the One-Hit Wonder. It's a 2015 post. And like, this is just, and I think it applies. It'd be really interesting to look at this. If you guys have a good data set on, like rock star managers over the years or something, and who knows, maybe I just go all the way back to like, the Graham and Doddsville old Buffett letter thing. But like, this is just wild. The 60s into the 70s, distinct charting songs. There was 6,800 distinct charting songs. So 6,826 songs, 1961 to 1970. The average weeks on the chart for any one of those songs was just shy of 8 weeks, 7.7 weeks. Flash forward to 2001 to 2010, there was basically half the amount of distinct charting songs, and the average weeks on the chart had basically doubled to almost 14. The more information we have, the more the way that we talk about this stuff happens, that fame part, to your point, Jack, becomes almost impossible. You have to play a different game to get famous than just put up the numbers, than just write the catchy jingle or string together a good year of calendar returns.
I'm wondering, like, if I look at the chart right now, is it basically like all 26 songs on Taylor Swift's double album or something?
It's very likely. We could pull it up and check. That could be a surprise. But yeah, it's very likely because you don't put up 1 billion streams on Spotify in that amount of time without knowing how to play the fame card right. And there's a handful of people that do it. I bet she's handily torching whatever Beyonce's doing on the country album. Not in a disparaging way. It's just like the ways you approach the fame on this stuff. Actually,
I wonder.
I don't want to put money on
maybe
that.
maybe I'm going off subject or off the reservation here, but I wonder if like the consumption mechanism plays into that, meaning that, you know, back in the 50s and 60s, it was probably mostly radio, if not all radio, right? You had one medium, where now it's radio, internet, streaming, which is internet, but, you know, and YouTube, I don't know, you know, it's just like, so, I mean, I guess it's really a function of probably competition. Maybe things are more competitive, so breaking through is harder now. I don't know, but that's a very interesting stat, I think.
And it gets interesting too, because at least on the music side, you go through who the great writers and composers and producers are of each era, and you might have 10 artists from like the Motown stable. So you have the same people basically like writing and recording the songs with a different figurehead on the front. You go through all these phases, and that's Like that's a regime thing too. There's regimes to fame and popularity. You got to know how to play what you're playing. And that's what the best artists do. It's a really interesting analog.
Okay. Next topic is these two sort of, I guess, are related in terms of the primary drivers of an investment strategy. So let me ask you, do you think taxes should be a primary driver of someone's investment strategy?
Yeah, I mean, these are going to be gray area questions. I mean, should it be the primary driver? No, definitely not. Should it be a primary driver? Yeah, for some people it should be. If you're in California and you're in the top tax bracket, and you're doing something that's very tax inefficient, yeah, I mean, the taxes are, the biggest cost by far, more than fees of an investment portfolio, at least a taxable portfolio, is taxes for everybody. So, if you can do things more tax efficiently, you should. Where people get into trouble is where they make it the number one driver, where they don't even care what the investment strategy is. They invest in these, like for instance, I could just buy for horrific stocks over and over and over again and lose money and realize tax losses, but eventually I will be out of money. And so
you're describing my investment strategy.
Right, exactly.
Every time I pick individual securities.
Call up Matt if you want to.
I'm an extreme tax loss harvester.
Right, exactly. But yeah, I mean, that's obviously an extreme example, but it gets at the idea. So I don't think it should ever be the primary driver of an investment strategy, but I think for a lot of people, and obviously our friend Wes Gray would agree with this, for a lot of people, it has to be a driver of your investment strategy because it is your biggest cost.
In financial planning, I feel like this is at least 50%. It might be 80% of the financial planning job is not taxes per se. So that shouldn't be your only variable. But for many people, that's one of the biggest bills they're going to pay in a given year. So we get the tax returns. We run the multi-year forecasts out on cash flow analysis with tax heavily included in the thing, because especially around transition points, I have 3 more meetings to go. We're recording this on a Thursday. I have 2 meetings tonight and at least 2, if not 3 tomorrow, where basically we're working through around a couple around retirement and a couple around like some career transition type stuff and kids in college, and another one where it's just like, you have to understand the tax liability in each one of these years and how it impacts everything else. And for certain people that can determine things like, like when they kicked back the RMD age, we talked about this on a prior podcast too. They pushed back the RMD age. That opened the conversation for a lot of people who had been expecting to take RMDs, but didn't need the money for consumption to consider the tax liability and do Roth conversions. There's all these examples where understanding taxes, because it's such a large bill, like you would think about if you're buying a new car, how much money you need out of pocket to buy the car. You should think about, many people pay more than a new car's worth of money to our good friends at the IRS. Like, this is a part of the consideration. Can't be the only one. If you're in a high tax state, maybe it factors in more into your portfolio than you would think. But from a planning perspective, taxes are just such a friggin' big cost.
Yeah.
Uncle Sam is not there to help you on this side of things. Yes, so you can flush your toilet, you should pay your taxes, but plan around it. There's a rule and a playbook for you to plan around. You're foolish not to.
I don't know if we ever told you this story, Matt, but a few years ago when we had our ETF, we had an investor on the private client side who, let's just put it this way, he was one of the first 30 employees of one of the most valuable companies in the world today.
It was Warren Buffett, wasn't it?
It was.
Okay.
You've broken confidentiality now. Yes.
Okay.
Yeah. Even if it was Buffett, I couldn't tell you. But anyway, so he was investing with us, and then we launched the ETF, and he moved his money entirely into the ETFs, which, as we know, ETFs are extremely tax efficient. And that was very important to him. And then when we ended up shutting the ETF down, even though I still think he believed in the systematic approach in our investment strategies, he decided to basically move that money, because when we shut the ETF down, we either had to move the client's money back into our individual stock strategies or give them the ability to take it. And he decided to take the money and do something more tax efficient with it. But, when you're writing checks on a tax basis for a couple $100,000, when you have that level of wealth and gains in a given year that are being realized, it becomes pretty substantial, especially when you compound it over. And I think this guy had like a, generational type of or decades long time horizon. Like this money wasn't going to ever be used probably in his lifetime. So that is an example where I can just, I'm not saying that that's the only thing, but it's one example I have in my mind of someone that, and I don't think he ended up, I think, looking at other similar type of strategies that were in an ETF wrapper effectively.
And adjacent to the investment strategy is also, this is why this is two quants and a planner. These things fold together. You can't talk about investments without talking about your plan for what you do with it. None of this exists in a vacuum. And just like with this guy, he had to make these decisions in the broader context of what he's trying to accomplish. Like, take it back to Taylor Swift for a second. Like, Taylor Swift knows what she's doing when she goes, you know what? I'm not going to fly coach. I'm going to jump on the private jet or whatever, right? Like, these are just decisions that we make with a fuller cost benefit analysis around them to understand both what we want to do and what we want to accomplish over our time horizons.
It's similar, Matt, to when I make a decision, I'm not going to pay $15 for the seat. And so I'm going to end up like by the bathroom in the middle seat. A little bit different than Taylor's, but same idea.
I mean, yeah, you and Taylor have a lot in common in that you were tortured poets of airline booking in your case, I guess. Yeah.
Over the years, I've had different friends and family reach out to me and ask me to look at their like 401k accounts, not on a formal basis, not being compensated or anything. Just like, hey, Justin, can you take a look at this and give me some?
I appreciate you got compliance out of the way as fast as
exactly.
possible.
Get that disclaimer in there. But it's, and this plays into fees. Like I always, because these 401k plans, you have a limited set of funds. You might have, I don't know, a couple in the large cap, couple in the mid cap. There's maybe a real estate one. There's sometimes isn't like anything in the small cap. There's obviously bonds and then whatever. It's pretty plain vanilla. There might be like in the plans that I've looked at, it might be anywhere between, I don't know, 20 to maybe 30 different options, something like that. And I always like find myself, just because I know that the fees are extremely important, I like go down the list and I'm like, what one's the cheapest? Like check, check, check. And that's kind of how, I'm not even almost looking like for me when I'm looking at those plans now. Now, I'm not saying this is right. I'm not saying this is the way to do it. It's just because this question of, should fees be the primary driver of your investment strategy? Like I found myself when giving like just some thoughts to people that I do use fees a lot. I'm like, you want to be in the cheap stuff. Now that tends to be like broad-based, like index-based funds in there. They're not like the more actively managed ones because those are going to be more expensive. And I'm not going to spend the time doing like, this is like kind of a quick hit thing. I'm not diving into each fund and looking at the manager and looking at the strategy, looking at the holdings. I'm just kind of leaning on the fees and then giving like perspective on that. But I mean, I don't know, the question we want to get at here was, should fees be the primary driver of an investment strategy? And you guys can give your thoughts, but it's just interesting that I find myself doing that with like the 401k stuff I looked at.
Yeah, with both of these, the word a versus the is the whole thing. Like taxes should be the primary driver of investment strategy. Absolutely not. It should be a yes. Same thing here. Fees should be a primary driver of investment strategy. Yes. They should be the primary driver. No. So like, there's two different ways to look at this. Like let's assume Jim Simons is a huge fan of this podcast, which I can only assume he is. I mean, I don't know how he couldn't be. Now let's
is that who invested in the ETF? Was it the Tiger Global employees? Okay.
Let's assume Jim, called us up and he's like, because I'm a huge fan, I'm going to open up the medallion fund to Justin and Matt exclusively. And that's it. Like, are you going to invest in the medallion fund? Are you going to give him some money?
Yes.
Yeah.
At 60% gross returns, I'll take it.
Right. So his fees are 5 and 50. So that's one side of the argument is you could say, even at the most outrageous level of fees possible, if the manager is actually backing them up, then you should, then fees should not be a primary driver of what's going on. The primary driver should be the after fee return. Now, having said that, when you think about this collectively, it's very hard for an individual investor to figure out in advance whether somebody is going to justify their fees. And whenever you're different than the market and the fees are higher, it becomes very challenging to do that. And so that's why on a collective basis, it is pretty reasonable to try to invest, try to use fees as a primary driver of what you're doing, because most people who charge the higher fees don't deliver on the higher fees. Now we have things like we do with factors where you can argue, well, factors are tested over a long period of time. And so therefore, they can justify a higher fee, and you can certainly debate that. And I would argue they do. But the reality is, and so I think that's why there's both parts to the argument. On an individual basis, yes, if I know with a high degree of certainty, as I probably do with Medallion, that I'm going to get a better return than the fees, then I should pay whatever fees there are. It shouldn't matter.
Right.
But collectively, I think you have to consider fees because most people don't deliver on the value.
Especially in the factor sense. And this is a probably more nuanced, although you guys can definitely weigh in on this probably in more depth than I can. Like when we think about things like beyond fees, you think about things like tracking error, you think about things like this. Justin, I can't tell you how many times I've looked at a plan for a family member or a friend, and it's like, oh, you have an S&P 500 mutual fund in here. And you're like, oh my God, it's one of these like 80 basis points or 50 basis points or 120 basis points, S&P 500 fees. And you're like, I'd love to tell you to do that, but like, this is shooting you in the foot more than, I don't know, whatever other possibly active version that has a lower fee.
Is it,
so
by the way, Matt, is it just taxes that allows those things to persist? Like somebody in a 1.2% S&P fund, they've been in there for 30 years. They don't want to pay the tax, so they can't get out of it. Like, because it's amazing to me those things still exist.
I would think too, you don't know the revenue sharing deal on the back end. Like a lot of these places might have a rev share deal, and those are like legacy funds that.
I'm just thinking, why doesn't the end client though get rid of that fund?
Well, I don't think they know, do they?
Number one, have we done a 401k fees episode yet?
No.
On this?
Will it make me angry?
So. Yeah, it'll make you angry,
Okay.
but it'll probably be worth it. For the notes, we should probably do a 401k fees episode and just talk about like all the layers of this. So in those funds, like when we see like the 1% S&P 500 funds, you have a couple of things. So first off, on the tax side, the thing that sucks is a lot of people have gotten wise about these things. They've gone, oh wait, I can get this at Vanguard for way cheaper. And if it's not in a 401k and it's fully fungible, meaning they can just go do it, they're going to do it. Hey, Justin, what happens when a bunch of your fellow shareholders in your S&P 500 index mutual fund all start redeeming their shares of said fund? Who pays the taxes?
Yeah, the shareholder, the guy who's holding the fund.
The remaining shareholders as they liquidate to pay the people out. Now, the people who sell theoretically pay their long-term capital gains on whatever else, but a lot of your residual shareholders are burned with the cost of those transactions, and presumably in one of these funds, there might be a bunch of embedded gains that liquidations trigger and distribute to shareholders. So that's one way it sucks. So maybe you're ignorant of that. So now you're overpaying on the fund fee and you're getting these capital gain distributions because there's net liquidations on the fund. That would suck. That would be annoying. And then the other thing these things persist is because people just have to definitionally be blind to all that stuff going on. Inside of a 401k, where there aren't the capital gains distributions, is probably where some of these things are allowed to exist because you don't see those capital gain distributions or whatever else. You could have a hemorrhaging fund that if it's primarily owned inside of retirement accounts or 401ks, somebody goes like, oh, I own the S&P, but maybe you do, maybe you don't. And that's an ugly wrinkle, but it's very there. It's why having a fiduciary or somebody to look out for you can actually they can save you more money than they cost really quick by just helping you get around some of this type of garbage.
This next one is something that I'm curious what you guys think of, and that is that your house should be considered part of your investment portfolio. And let me give you like the way I think about it. For me personally, I think I do look at my house as, well, two things. I do look at my house as part of my overall net worth. We've been living in this house for 20 years. And so at this point, there's, a decent amount of equity in the home. So it's not like I, have a 30-year mortgage and there's no, so I think about it that way. And I also sort of think about it like when my wife and I retire, we live in Connecticut. It's kind of a pretty high tax state. I don't know. A lot of older people are kind of getting out of here just because it's like expensive to live in the Northeast in general. I like Connecticut. It's got a lot of good qualities, but I don't know, when we get older, if we'll stay here. And so I do view it as, an asset that, there will be some unlocking of value at some point. Now, at some point I'll have to buy something else or whatever we decide to do. But that's how I kind of look at like my home, I guess just for me also from a disclosure standpoint, I do have some investments in real estate assets, like hard assets. So from an overall portfolio diversification standpoint, I get my real estate like exposure as an asset class from somewhere else. Like I don't look at my house as like my real estate exposure in my portfolio, although maybe you can make the argument, given what I just said, that you are looking at it that way. But I kind of just look at it as an asset. At some point, there'll be some value, hopefully being able to be unlocked. And yeah, I don't know. How do you guys think of this?
This is a tough one because a house really is a consumption asset and it's also an investment at the same time. So it becomes challenging. This question actually came from our interview we just did for Show Us Your Portfolio with Jared Dillian, because he strongly feels it should. The vast majority, we'll see what Matt says, but the vast majority of people in the planning community will kind of say, no, you take it out when you build your portfolio. He thinks the other way. He thinks your house is part of your portfolio. And I mean, maybe the answer is like a hybrid in the middle. I don't know. Like I'm one of these people who has a significant portion of my net worth in home equity. So I feel like I do have to consider that. Like when I build a portfolio, I have to consider, do I want to invest in things with the same risk exposures that equity would have? Do I want to invest in more liquid things on the other side because the house is not a liquid thing? Like, I feel like I have to consider it as part of my portfolio on that side. But then I also understand the arguments, like I live in it. It's a consumption asset. Like, yeah, it's a very different thing than's in my portfolio. So Matt, you are the expert financial planner. We are the two quants. So you can tell us the answer to this one.
So first and foremost, when we talk about real estate that you own, that you live in, that you rent out in some cases too, we're talking about a private asset. This is not a market traded asset. This is generally speaking an illiquid asset in the sense that you're not trying to day trade your house. So that's an important thing. Now, from a snapshot perspective, estate planning, you have to include it. You can't just ignore the house just because it's illiquid, because you might live in a friendly state like, Justin, don't move to Massachusetts when you retire. That's probably a good thing, or at least don't pick up the house, move the house and all of its equity to Massachusetts. States that have lower thresholds on their estate tax for when you die, you got to be aware of this stuff. Your home equity is going to factor into it. It's part of your estate. One of the things you own, even if you don't do it. I a few years ago, had a couple of clients that got bit by, I pick on Massachusetts because they're one of the $1 million thresholds. So you're probably going to have a trust. You're probably going to have some stuff set up, especially if you have real estate in one of those areas, because if you pass away and your assets are more than $1 million, there's a progressive tax at the state level that's coming for some of your stuff. Things like real estate can tip that scale. On the pure planning side, and we've talked a lot about this on prior episodes of the show, so I'll just summarize it quickly. We tend to think about on the balance sheet primarily 3 buckets. For most people, these 3 buckets are going to cover how they think about their assets broken out over time and liquidity needs. Your first bucket is basically money you need liquid. That's your checking and your savings account. That's what you're doing to pay your general expenses and things like that. Your second bucket is things that you know is coming up down the pike. You don't exactly know when, but you're pre-planning or you're earmarking the outflow. You have a kid who's going to college in 10 years. You have 529 money. That might be in bucket number 2, because you know the kid's going to go to school. You know there's going to be an outflow, but they haven't picked the school yet. They haven't picked those details. Bucket number 3 is when we get into our long-term assets. These are things that don't necessarily have something specific tied to them, or they're too big to tie one specific thing to. So it might be retirement. My 401k as a 40-something is a bucket 3 asset. I don't need liquidity today. I can take more risk in that thing, but I'm not touching it for a while. And someday, eventually, theoretically, I will. Back to the gift consumption point that you brought up. Everything's one of those 2 things. For your real estate or your home equity, this is the case where we start to introduce a 4th bucket. This is especially prevalent for people who have privates or illiquid investments in their portfolio. If you have a multi-million-dollar house, if you have a series of real estate, if you have a bunch of private equity holdings, if you have private credit, if you have venture capital or something like that, this is stuff that we usually segment away from the liquid assets in the first 3 buckets, and we put in this 4th illiquid bucket. And that's because at any point in time, you might sell something, you might have an event, but now you have cash. or you have a distribution of stock from that angel fund because you wrote the first check to something that went public, whatever the dream is, that now gets converted into one of the other buckets. So the snapshot in time when we're planning the house, it's not a liquid asset. So get it away from the other liquid assets the way you're planning around it. But when an event happens, when it converts, be ready to think about it in a new and different way. I'm curious to hear how Jared Dillian says that. I was asking you about how that one went before, so I'm going to listen to this episode.
Yeah,
but I think it's important that like he took liquid assets to build this illiquid house. And at some point, don't lose sight of it, but that illiquid asset might become liquid again if he ever has to sell. That calculation and that separation is really important, I think, to most clients.
I think the question is the personal residence in bucket 4? Because you could think about it, if I have two different things, I have a rental property and then I have a personal residence, they both are illiquid, private, real estate investments. What a lot of people I think will say is, well, the house is a consumption asset, get it out of here. It's not part of the portfolio. And then other people will say, well, most people, I think the stat is the majority of Americans have more than 50% of their net worth in their house. So it's a huge asset for everybody. So even though it is a consumption asset, like we got to consider it in the portfolio. We got to put it in bucket 4. And I think that's the debate. And that's the hard part about it.
And I think there's a huge working with people well across the wealth spectrum. This is one of those things too, where it would be dangerous to suggest to somebody with a couple $100,000 in assets that's retiring and primarily living on Social Security to basically say like, think about your house as part of your asset allocation and therefore be more risky. That could be a dangerous proposition for them because the house really isn't liquid. They really need it to live in, and that shouldn't change their risk spectrum with their other liquid investments. Versus if we're working with a family office and they have $1 billion and they have multiple pieces of real estate in multiple places, then we want to go like, okay, you're never going to want for a place to live with this other money. Let's really think about how this gets gifted, passed on, or distributed elsewhere. There's a lot of error between those two scenarios and a lot of nuance to your point, Jack, that I think there's a reason people hire us to help us think through this type of stuff.
Yeah, his awesome portfolio has 20% in real estate. And I think what he was saying is basically, if I have a lot of equity in a house, I have to consider that in my 20% that's in real estate, because this isn't, although it is a consumption asset, it is an asset. It is something that's going to go up and down with the value of real estate. And so I think that was his argument for it. And I tend to agree to some degree, for if you have a huge portion of your net worth, like, or even a large portion of your net worth in a house, like it's got to be considered at these various steps. And, I might want to change the rest of my portfolio to have less real estate exposure, or, I might want to change my portfolio to be more liquid. Like, I think that's perfectly reasonable, but you also have to understand what it is. It is different than a standard investment. It is something you need to live in. Obviously I go blow my money day trading stocks tomorrow. I'm still gonna have a roof over my head. If I go blow the house, then I've got nowhere to go. So it has to be treated differently, but I do think it's important to at least consider it as part of your allocation.
It's such a fascinating and nuanced conversation. It's so important. And you have to think about it. And like for most of our clients, we are allocating to liquid stuff. We own REITs as part of the allocation. We own infrastructure as part of the allocation. You can do both things at once, but you definitely have to size them. It's just as true with if somebody has all of their money tied up in like pre-tax traditional IRAs or 401ks. If your portfolio is getting lopsided into one of these things, you need to have the exercise of taking the bigger snapshot to understand, oh, look, I'm lopsided. I have all of my money in the equity in the house that I need to live in. And like, oh, by the way, I also have all this REIT exposure or something in my portfolio. You should be aware of those things. You got to have some exercise to check it all out.
So Justin, before you ask this next one, I'm hoping Matt gives the right answer here, because we've got a 12-hour live stream coming up next Tuesday, and my coffee is going to be a huge part of this. So I'm hoping Matt does not tell me that I can't have my $4 coffee anymore. Matt, this is something you see all the time. This also came out of our Jared Dillian episode, which is this idea that you see all the people that do they take the $4 every day, they put it in the time value of money calculation, they compound it out for 40 years. I've got 150 grand at the end of 40 years. I mean, I'm probably dead, but I've got 150 grand. Like, how could I possibly have the $4 cup of coffee? So I think the factor of fiction here was avoiding the $4 cup of coffee has significant long-term investment implications. So this is probably one for you more than us.
I mean,
it's one of those things. You can put anything into a spreadsheet. I'm gonna follow with, I believe Bill Perkins and Die with Zero attacks some of this stuff too. Like, money is for experiences. Ultimately, it's a gift or it's consumed. If buying the $4 cup of coffee helps you out for the rest of your day and it's good and you've checked the numbers, you can spend money on stupid stuff and you can not have enough money to live the rest of your life on. This is a very achievable goal. There's a lot of people making disastrous money decisions that if they just did things the tiniest bit smarter, they would get further ahead in life. I watched a person get like Uber Eats, like while they were more or less waiting in like a glorified line a couple of months ago. And it was like they ordered Uber Eats from Dunkin' Donuts. And I was like, that must be a $15 coffee. Shame on all the $4 coffee people. This woman is showing you how to do it while she waits in a line and orders Uber Eats because somebody made her wait. So I don't know. If it makes you happy and you can fit it into the budget, you should be okay with it. And I think this comes down to it too, a related point. The Bone Parts and the book that they're working on together that I can't wait for. They had a whole thing about like, don't give your budget or don't give your spouse a budget. You should have like a household global view of what you're doing. And you should just not use these things to shame people. The $4 coffee, when it's used to shame people, you lose track of the financial results. I mean, I don't know. I hate spending money on coffee. Like I will if I'm away from home or whatever, but that's one of the things that bothers me. Where do you guys come down on this?
So wait,
is $4 going to change your life?
So the $4 is okay, but the $8 Uber Eats coffee that I pay the additional $4 to have delivered is not okay.
I mean, if you can afford it and it makes you happy, great. I'm going to venture to guess the person I saw doing this does not have the money to afford it. And it was one of those real head scratcher of decisions where it's like, even if you're not a financial planner, you know, this is probably a regrettable purchase or a regret worthy purchase.
I agree with you. I hate the Uber Eats stuff, but Justin, what do you think?
Well, I mean, every day I get my daughter off to high school, get my other one on the bus, who goes to elementary school. And then around 8:20, 8:30, I hop in the car. I go to Dunkin' Donuts, and I actually almost every day have a call with one of my good friends. So I end up, for me, the coffee is part of like a ritual that has been happening over a few years now, where me and my buddy kind of chat about life and family and friends and business and the economy and Trump and Biden and
well, let me tell you all the problems with that though. So first off, you're bucking the loneliness epidemic by having a friend. So the idea that you're going to have a friend means you're going to friggin' live longer, which means you need more money, which means you're spending that money at Dunkin' Donuts and you're going to live longer. And now your whole retirement is messed up because you chose friendship. What's wrong with you?
Oh, no.
I mean, Matt, the ultimate investment strategy would be like lock yourself in or like long-term strategy, make your portfolio last as long as possible, at least relative to your life would just be lock yourself in a room, right? I mean, your life will be shorter, but the money will make it till the end. You won't spend anything.
This is one of the genius, like, tangential points to like the Die with Zero crowd and these people is, so take all these things to extreme, turn them up to 11 to use the Spinal Tap language for this stuff. And like really think about this. If I'm not going to spend the $4 from college and I'm going to put that into the retirement account or whatever, so now I theoretically have millions. It's like, well, why stop there? Why stop there? Why not live in a room? Why not starve yourself? Why not let's go be Gandhi about it for Christ's sakes. Like, what do you want to do? Where do you draw the line? And again, it's consumption or a gift. You're either going to spend it or you're going to give it away when you die. And think about it like this. Justin, the idea that you have a friend that you have a ritual with, my God, I will buy coffee for both of you once. There's a limited time offer.
Sweet.
But an encouragement, because I think that is a truly fantastic thing. You should have excuses and hopefully put yourself in a position where you have discretionary budget to make little stuff like this, because you're making your life better. You're making a friend's life better. You're probably in a better mood with your kids when you drop them off for school because you're looking forward to this thing. That's a compounding effect I can get behind.
Nice. Love it. Thank you guys. This has been good. I think, wide range of topics, wide range of opinions, but, there's no right or wrong answer to a lot of this stuff. And some of it's a little bit more gray, shades of gray than others, but we appreciate everyone listening, and make sure you check the P&L for a Purpose live stream on April 30th. It's 12 hours of interviews with 24 guests. It's going to be great. And thank you guys for watching. We'll see you next time.
We're going to drink a lot of coffee to go those 12 hours straight, right, guys?
We might even shift the drinking to a happy hour towards the end, too. So we might cover the entire game by the time the thing's over.
$4 coffees all day long.
Hi guys, this is Justin again. Thanks so much for tuning into this episode. You can follow Jack on Twitter at @PracticalQuant. You can follow me on Twitter at JJCarbino and follow Matt on Twitter at CultishCreative. If you found this discussion interesting and valuable, please subscribe in either iTunes or on YouTube, or leave a review or a comment. Also, if you have any ideas for topics you'd like us to cover in the future, please email us at excessreturnspod@gmail.com. We would like this to be a listener-driven podcast and would appreciate any suggestions. Thank you.